A lot of investors are looking for bargains out there right now, and there's a chance you may be looking at banks. After all, the sector is pretty well beaten down still. This past March, we saw a number of banks taken over by the FDIC. We saw another one with First Republic in May. There are a lot of reasons to be uncertain about banks, but there's also definitely some opportunity. I'm Jason Hall. This is The Smattering, and I want to talk about my favorite bargain bank stock that investors should be buying right now. Before I get to that, though, we're sponsored by The Motley Fool. We have a great partnership with The Fool, and The Fool can help you invest better. If you're looking for even more great stock ideas than the ones we're going to talk about right now, go to our special link. You see it right above my head, fool.com/The Smattering. The Fool is going to give you its 10 best stocks to buy right now. Be sure to check that link out when you're done with this video. All right. So what's going on with banks? Again, Moody's just downgraded 10 banks, cut their credit rating. They've got another half dozen that are lined up for review. And there's another 11 that Moody's has turned their outlook to negative for. So what exactly is going on? Here's the first thing. Interest rates have absolutely skyrocketed. Generally, rising interest rates is good for banks. Why is that? When interest rates are being increased by the Fed, the economy is in good shape. It's doing it to kind of cool the economy off. Rising rates usually means that banks can raise the rates they charge on loans faster than they have to raise the rates on depositors. So they can increase their net interest margin and make more money. The problem is that rates have skyrocketed so much so quickly, it's kind of flipped everything on its head. Simply put, depositors are demanding more yield. The mortgage market has frozen. As a result, there's not as much opportunity, and we're starting to see some compression on the interest margins and the profitability for banks. Now, I want to talk about a bank that I think is a little bit immune to that, and that's Axos Financial. Axos Financial has a great loan portfolio, and Greg Garrabrants, the CEO, has spent the past roughly 14 years rebuilding the bank from just a mortgage lender focused on jumbo loans in Southern California to a diversified financial services provider. I want to show you a slide here from their most recent earnings presentation that shows how their loan book is really set to profit in this sort of environment. Most big banks hold a lot of fixed rate loans, lots of mortgages, lots of auto loans, things that are at fixed rates. Whatever the rate you sign up for, that's the rate until the loan is paid off. Now, you see, that's not how Axos's loan book is set up. The vast majority of their loans are variable rate, 59%. What that means is those variable rate loans, typically, they'll adjust every year. So they're starting to benefit from rates going up. What does that mean for Axos? Net interest income has increased almost 29% over the past year. That's a strong indication of how they've built their loan portfolio for the long term. Then they have another third that are hybrid loans. And what are hybrid loans? In short, it's a longer term of fixed rates, and then it becomes an adjustable variable rate. So how does that work? So you see right here on this chart, it shows that roughly over the next 3 years, about half of that hybrid book is going to convert to adjustable rates. So even those hybrid loans are going to adjust up. Put it all together, and only 7% of its loan book is fixed rate mortgages. All right, so what does that mean? That means if we take a look at its net interest margin, again, these two columns here are the full year. It just reported its fourth fiscal quarter, and that's why its net interest margin was actually up over the past year. But here's the big thing. You see this net interest margin that it's getting? 4.34%. I want to compare that to a couple of big banks to give you an idea of the kind of net interest margin that you see from other banks. Now, the first one I'm going to show is Truist Financial. Disclosure, I own some Truist Financial. I think it's a great bank, but there is a difference in the kind of margins that these bigger banks can get than Axos Financial and other banks like Axos. So its net interest margin last quarter, 2.91%. Again, to put that in perspective, that is a massive increase in margins that Axos Financial gets versus these others. You'll also see, and even though the net interest margin is up a little bit year over year from the second quarter, Axos Financial full year net interest margin increased pretty substantially, 21 basis points. That's a pretty big increase year over year. All right, I've got another one here that I want to share for you, and this is US Bancorp. Again, 2.91%. That's up year over year, which is good. Now, it does have some variable rate loans that are part of its book, but it was one of the banks that's a little bit of concern because it has a fairly large amount of commercial lending activity. And enough of that is tied to things like office spaces that Moody's is a little bit concerned. The last thing about Axos really appealing to me right now is valuation. I'm going to compare it to US Bancorp and Truist, of course, but I'm also going to add Bank of America. I want to get one of the big banks on here as well. First of all, you see with Truist trading for less than 7 times earnings and about 70% of book value. So because of some concerns about profitability, its loan book, the levels of yields that it can earn, it's priced pretty appropriately. It really is. But what I want to highlight is if you look at Axos, about 1.3 times, it's the most expensive, priced similar on book value to US Bank, and it's still, again, a premium to Bank of America. Again, you look at it on a price to earnings ratio, trading for about 8 times earnings, it's actually cheaper than US Bank and cheaper than Bank of America. So what does that mean? That means that you can buy a premium bank, a highly profitable bank that generates better margins and is better positioned in this environment to remain highly profitable for basically the same kind of valuations you can get banks that frankly are a little bit inferior in terms of their profitability. You might not be familiar with Axos, but I can tell you, I hope after watching this video, you're willing to put in some research and see if maybe it should be in your portfolio too.